Welcome back, everyone. It's the last day of the month. We wanted to give you a market update and a review. So, Quint, tell us what's going on.
Well, it's been one of the worst starts. I saw a stat recently today that it was the worst 6 months in 52 years for the general market. I believe as we sit here today, which literally just a few minutes left in the trading day, the S&P 500 is now down 20%, almost right at the 20%. At least right as we were coming, it might be a little bit lower. It was lower this morning for sure. The Nasdaq is down 30%. And there's a slew of sectors, individual stocks that are down much, much more than that considerably. It is, for all intents and purposes, been a significantly difficult environment. You'll hear terms like volatility. We've talked about that ad nauseum. Volatility is code for lower stocks. And that's what we've seen. We've seen a very difficult environment here.
So, what's going on? I mean, if people have joined us for our webinars, we've talked in detail about this, but what is happening in the world? What's causing this, and what can be done about what's happening?
Yeah, that's the prevailing question that a lot of people have. I think one of the great things and most difficult things about the market's all opinionated. You know, somebody can have a strong opinion of why this is happening. Another can have another strong opinion. There's a lot of smart people that have strong opinions. My personal opinion, and I think it's valid, and I would say most would agree with this, is that we have lost complete confidence in the leadership right now in the markets and the economy. And I'm picking my words very carefully because you'd think I'd just say the administration. I'm not. I'm saying the Federal Reserve I would lump into that category as well. And the reason I say that is you don't have to be an economist to understand we have one major problem in the United States right now. We have significant oil prices.
Yeah.
Oil prices are trading well into the hundreds. That is causing a tremendous constraint in the oil markets, and ultimately gasoline prices are well into the $5 average across the United States.
Which is basically going off into everything else.
Everything. So when you transport food from point A to point B, diesel fuel is well over $6 now a gallon. When you move something on a ship, that fuel, on that ship, anything that has to move around, which is everything,
right,
that comes back to oil. And the two primary reasons that oil prices are the way they are right now is a combination of our current administration's energy policy, as well as the energy crisis that's happening due to Russia and Ukraine, right? Russia, one of the largest oil producers, and basically the world has shut them off. Now, that's not just what's happening, to the stock market. What's happening to the stock market is the Federal Reserve. We talked about this ad nauseum, so I don't want to spend too much time on this. But the Federal Reserve is having a response to these issues that honestly makes no sense whatsoever. And what's probably most frustrating to me is there's a lot of people coming out, smart people that I have respected over the years, saying that the Fed should do more. What I don't understand about that is I don't know how the Fed, just by raising interest rates, is going to impact oil prices or gasoline unless they go so far as to deteriorate the economy so much that demand, people driving, people using, buying goods, etc., falls off a cliff so far that oil does come down, right?
Right.
So the irony is that a lot of the input prices that we've seen over the last year and a half from COVID and manufacturing issues, etc., supply chain, they have started to come down considerably. All of the raw materials, whether it's, lumber, steel, iron ore, commodities like copper, wheat, just basically crashed the other day when there was news that, Russia was going to allow some wheat to leave Ukraine. So a lot of those prices have come down. There's one area that has not, and it's oil.
Right.
And so again, it's the market right now selling off is saying, well, if the Fed keeps doing this, we're just going to derail the economy.
Yeah.
And may or may not even bring the inflation rates down. So that's what the market is responding to.
So the market's basically saying, okay, we are not necessarily in recession right now. We're not in an economic recession right now. I mean, there's very low unemployment. There's high demand. People are traveling and stuff like that. But it may be predicting something in the future.
Stocks are always foreshadowing. They're a what's called a discounted mechanism. So a lot of times, what the stock market does, it kind of clues or predates or predetermines what the economy will do.
Okay.
So that's not a good sign. If the stock market is trading in bear market territory and the economy is strong, right? Now, the irony is the definition of recession is 2 negative quarters of GDP. Quarter one was negative 1.5. We don't have Q2 data yet. I got Atlanta Fed came out and predicted that GDP would be negative 1% for Q2. Janet Yellen was out the other day, Treasury Secretary, who said, oh, we're going to have a positive, we're not going to a recession, positive GDP. The data is the data, so we'll know in a few weeks. But what I want to focus on right now, however, is with all this going on, obviously our conversations, we talk to people all the time. We're communicating via, our writings, our webinars, et cetera. But the hot point is, okay, well, what do we do? What do we, what should we be doing? Well, the reality is going all the way back to the fall of last year, right, when we started talking about standard deviation, risk allocation, et cetera, and even writing, hey, there's some challenges on the horizon. Never did we see, us slipping into a bear market in the first 6 months of this year, but obviously always a possibility. You should be in the allocation that you desire to be in through a variety of markets. Nobody's time frame, at least I hope not, is next week or even at the end of this year or even next year. Allocations should be appropriate to weather different storms that are on the horizon, as hard as it may be. This too shall pass. We know that. We've been through very difficult times in this country, even in the last 2 decades. Even in my tenure of 22 years, whether it's the World Trade Center, whether it's financial crisis 08 and 09, whether it's COVID and now this, we've been through difficult time periods. And so I'm confident we will push through this. Now, let me tell you why I'm actually more optimistic than most right now. I'm more optimistic than most because by the Fed doing what they've done, which is to raise rates, and I think that they'll continue, and the market's pricing that in. So if you think that there's going to be some great surprise when the Fed raises another half or 75 basis points in the market, there won't be. That's already priced in. In fact, the market's pricing in a lot more.
Right.
But interestingly enough, the Fed has built in some power to reverse that now. So if the economy starts to show signs of weakening, which I actually believe it will, the Fed could backtrack very quickly. And a lot of people, myself included, think that'll happen.
Okay.
You have to understand, when the Bank of Japan started a monetary sort of stimulus act, I think it was around 1990 in Japan, their intention was for it to be short-lived as well. Bank of Japan is now the largest owner of bonds, corporate bonds, in the country of Japan. They're the largest owner of stocks in the country of Japan. So we have a long way to go for our monetary system to really be tested in this country. So a lot of what we're seeing in the market now with pulling back and a lot of the stock prices, I've never seen a sort of government or agency imposed decline. I'm hard pressed to call it anything else. The economy was good.
Right.
Things were good. It's them pushing the brakes and pushing this down. But it also says, especially with elections coming up, they can undo this very quickly. So there's some stats flying around about, I told you we're 6 months and 52 years and what happens after we have difficult, 6 months to begin with. And those stats are very good. I have a hard time buying into that because you never know. But do we have the one thing I want to bring up, if you have it, if you can pull it up? We talked about we did a chart when we did our webinar, and if you weren't on the webinar, this is a really good, I think JP Morgan did a nice job with this chart. There's a lot of data on here, but I'll throw it out and you can understand it, is that the bars, the gray solid bars, are basically the end of the year returns in the S&P 500 in any given year. Now, I want to preface, as I've had some confusion about this, more than likely, if you own a diversified portfolio, you own more than just the S&P 500. So that's international and emerging and gold and different things along those lines. So I always have people that get a little bit confused about that. But nonetheless, when we talk about the market, we like to talk about the S&P 500. It's a good indicator. But the big bars that are filled in gray, that's the closing value or return for the S&P 500. However, the red dots underneath are the intra-year moves that transpired to get those gray bars. Now, everybody wants the big gray bars on top, right? The 19s, the 20s, the 30%, etc. Nobody wants to go through the red dots. I get it. I don't want to go through the red dots either, right? That's no good. But the reality is, as difficult as this environment is, when you take a step back, it's not that abnormal. I mean, it's not fun. Nobody likes it, but it's not that abnormal. We've seen this before. In fact, this chart goes back, 30 plus years. This is normal. This happens.
Right.
So you got to kind of ride it out. The allocation is appropriate, etc. Now we have another chart, and this goes back, and we'll keep hashing on this because this is a fantastic thing to understand. And I encourage you, if you haven't yet, to look at the webinar. Just go through it. I mean, this is finance. We spend time. We try to break it down in an easy to understand fashion. But we talked about standard deviation risk. What you can expect portfolios to move. And this, when we did this just a week or so ago, this was a snapshot of the movement of a portfolio. Standard deviation is what we can expect portfolios to do over time. And the red dot at the time was where a 60% stock, 40% bond portfolio was. Now, if you notice where the red dot is or where the red arrow is, it's significantly away from the average. Doesn't mean it can't go more. I mean, make that very clear. We know that it can go more. But the reality is we are in an environment that often reverts back to the average at some point. So again, you have to understand that I equate it to snow in April. If you're not from Kentucky, I'll never forget April of this year, mid-April, which is usually when the sun's out, people enjoy Keeneland, the horses, it's warm. We had snow. And I don't mean like 3 flurries. I mean like it was snow. The cars were covered, and it was ridiculous. But it passed. And, it passed quickly. This is now taken on 6 months, and I would argue that it's been 8 months because since November of last year, it's been difficult. But ultimately, we are outside the norms. Younger people, if you're watching this and you're a younger person contributing, ironically, this is what you want to see. You want to be able to buy markets at lower prices. Don't change your strategy. Continue to contribute dollar cost average. People that are close to retirement, be revisiting those plans. We're doing a lot with those folks who are making sure, markets are where they are. How does your retirement plan look? Are you still on track? Is the allocation appropriate? All those conversations. And then if you're retired, I get it. This can be a scary and a difficult time. You're drawing money out of retirement accounts. You have a fixed pool, and now that pool is down. And add insult to injury this year, bonds are down as well, right? Stocks aren't just down, bonds are down. In fact, that's creating more havoc in the markets right now than the equities. But again, allocations are appropriate for the long haul, and your time horizon should be end of life. It's not next year or the year after. So as long as that allocation is appropriate, you're in good index exposure, over time you're going to be just fine. But it doesn't make right now any easier. It certainly is a difficult environment.
All right, thank you, Quint. Well, I think we're going to wrap it up there. We know it's been a difficult 6 months. If you have questions, if you want to contact us, feel free to reach out. We hope everybody out there has a great holiday weekend.
Hey, let's hope that the next 6 months are a little bit better than this. Enjoy July 4th. Look, relationships, squeeze a loved one. Let's be thankful for the great country that we do live in, because that is the greatness of the country that I think we can all agree that we do live in, is that whether we agree or disagree about this policy or that policy, we have the freedom to do that. And ultimately, we can elect officials that can change those policies, and we could be on a different trajectory in very short order. So let's always just remember to keep the big picture in mind. Enjoy the holidays, and we'll talk to you soon.